I'm Rick Bensignor, and welcome to this week's In the Know Trader Show. Well, markets have recovered a fair amount since last Friday's presidential tweet that sent markets into a tailspin. So we'll talk about that as we always do, because we'll look at the S&P, and we'll talk about what's going on post-tweet. And then today's show, we're actually going to focus on looking at investing and putting positions on in other countries besides the U.S. ETFs make that really easy to do, and this is something that 20 years ago was a much more difficult thing to do. In order to, let's say, invest in a French stock, you literally had to have an account that was able to do that. You had to be able to transfer and buy French francs, or just about 20 years ago is when the euro came into being. And it was not an easy thing. Nowadays, you're looking at a list of at least a dozen or so country ETFs that we're going to look at today. And we'll actually start by looking at EWC, which is Canada, and EWW, Mexico, and kind of EWZ is Brazil. So the first three are North and South American, and then we'll make our way to Europe and then go over to Asia and look at some of these fairly large ETFs that get, these are all liquid, have decent flows, and are ways of getting exposure to different countries. And you might ask yourself, well, why do I want to potentially, let's just pick India, INDA. Why do I want to have exposure to Indian equities? Well, sometimes individual countries do much better than the U.S. does. Depends on the economic cycle and what's going on in the world. But strictly investing in the U.S. limits you to potential opportunities elsewhere. Now, you might not know what's going on in Taiwan or India or Japan and their equity markets and any of these, but as media coverage these days, it's very easy to find out what any of these indices for a particular country are doing. You certainly can pull these up on charts and look at them. I often like to do them in pair trades too, where I will pick, just let's say as an example, it's not a recommendation, but just for discussion purposes, let's just take a look at the first two on the list, EWC and EWW. So the first one is Canada and the second one's Mexico. So when the U.S. And President Trump was negotiating NAFTA to come up with the newest North American deal that includes Canada and Mexico, these countries were coming under more pressure. Their markets were than, let's say, the S&P was. So there are times that what you can do is put on a pair trade by, let's say, at the time, long U.S., short Mexico. And again, these ETFs are really easy. They have enough liquidity. You can short them and put on pair trades, so that when you put on a pair trade, you take the market factor away. Although these are actual market ETFs, what you're simply doing is comparing two like items, saying one of them will outperform the other. And you don't care so much which way the market direction goes, as long as the one that you're long does better than the one, makes more money than loses on the one that you're short. So if, let's say, you were long Canada and short Mexico, doesn't matter if the stock market globally goes up or down, as long as Canada does better or goes down less than, let's say, Mexico went down in that particular example, you'd still make money. So it's the same thing if you looked at Home Depot versus Lowe's, Coke versus Pepsi, etc. Ford versus GM. They're going to move very similarly, but one will outperform the other. And your homework is to find which one is likely to outperform. But you have a chance of making money on this trade, even if you're wrong about the direction of the overall market movement. You just need to know which one's going to do better than the other. So we're going to get through as many of these country ETFs as possible. And then, just as a reminder, tomorrow, for those of you who get Real Vision, now realvision.com is very up and coming financial site that interviews people on Wall Street. That's the main core of what they do. There's some research and other things to it that's on a subscription basis, but a lot of what they do, and if you go to realvision.com, is free. There's some great interviews there. Most of the interviews I do on Real Vision are free under the section that's called the mental game of trading. So there's some that's paid for and some that's not. And they told me that a recording that I had done earlier in the summer with 2 other people where we discussed behavioral finance and how it affects markets and portfolio management. So that video comes out tomorrow on Real Vision. I do not know if it's in the free part or not, but giving you a heads up that that does come out tomorrow. So let's start off with the comparison, just as we generally do, looking at what the S&P macro sectors have done this week through yesterday's close relative to what they did through last Wednesday's close year to date. And again, these come from StockCharts.com. These are performance charts in bar form, and what we can see is a continued outperformance on the far right side. Real estate has again made a new relative high for the year. It's now outperforming the S&P by 15.6%. Last week it was only by 14, little over 14, so it picked up 1.5 full points of outperformance, or percent of outperformance in the last week. So that continues to be a shining star. If you look at the kind of brownish maroon colored utility sector, that's now up 6.75 versus last week, only up 4.12. So that gained also 2.5% last week as the market got more defensive. Healthcare, actually, no, healthcare not much. Staples up 6.5% versus 5.5% or so a week ago. So that picked up also a full percent. And on the negative side of things, energy, which has been the dog of the year, got to be a worse dog, now down 16.5% versus the S&P. A week ago it was only down 15%. So they continue to pummel that. And interestingly, even though the metals markets are flying, so if you look at gold stocks and you've been involved there, they've ramped up dramatically in the last month and a half, yet collectively, material names have lost ground in the last week, down now 5% versus the S&P, whereas last week they were only down about 3%. So they lost 200 basis points of performance. So again, always interesting to see what's going on in the sectors, and certainly the market has gotten more defensive in the last week or so, especially with Trump's tweet on Friday. So let's switch and move to our charts, and we'll start off with the S&P. And this is real time as we record on Tuesday morning. So right now the S&P is just about 2890. It got, here, let me see, today's high as of now is 2899, so it's pulled back from the high. And the important things to see here, and as we've talked about in prior weeks, is the top that came in right near our target of 3032, accompanied with both an aggressive and a standard sequential upside exhaustion 13 reading. You can see those right near the top. We've sold off, but if you look at the month of August, you pretty much see a range that we've been in from roughly 2940 to I don't know, about 28.25. So in the S&P futures, S&P futures have a bigger range. It got as low as 2810 on Sunday night, but rebounded 80 points into today's high or so, or 90 points, because futures got up to just about 3,000 today. But we're pulling back a bit, but still having gapped up. We've gone short term. I'm actually tactically having institutions sell into the range we're in right now, basis my Sunday night report that goes out to institutional clients. My guess is that, and the way I'm looking at this is that Trump's recent, we'll say Friday tweet that's in the market spiraling, I don't think that one's so easy to walk out of and just pretend like it didn't happen. And so I waited for a rally. Instead of selling, Friday into the whole weakness, I suggested selling between 28.75 and 28.95, more so because it's kind of mid-range, and he has a tendency of trying to back away from maybe a tweet that the market didn't take well, and that's exactly what he's done over the last couple of days, including yesterday's press conference, which had the market basically close on the high. I'm not so sure that this one's going back towards the top of the range. I think that, you can't always walk back everything you say. And the thing that got me most was putting Jay Powell into the same category of China, saying they're both essentially enemies of the state. And then yesterday at the press conference in France, Trump said that, China is very much wanting to put together a deal. We had a phone call over the weekend. President Xi is my friend. Well, you can't call a guy who is an enemy of the country your friend too. It's this one, I'm not so sure. So I'm thinking up in here is not a bad place to kind of get a more defensive. Notice also from this chart, look at the bold blue line. That is called the lagging line. It's part of the cloud model. And you can see the 3 equal lows or so. Now that's based on settlement price right near 28.50. So even though we've gotten lower than that, somewhere between 28.35 or so and 28.50 have been those 3 settlement prices. And so the market's still hanging in there, but if we close underneath that, then and kind of break down, then I think 27.94 becomes next. And then of course the chance for the testing the double bottom somewhere around 27.25 or so. There were both the March and I guess beginning June 1st or so low. So that's my take on the S&P. I'm right now neutral to mildly bearish for tactical traders, long short books, which institutions often run, just like I was saying about pair trading. Institutions often run long short books, meaning they're long something and a short against it that's similar, like the Home Depot Lowe's type thing, Kroger's, Pepsi, etc. They often run books like that to take the market exposure away and just hammer down into the fundamental research they've done on company A versus company B. So there we've taken their exposure down, their bias down to neutral, meaning we're no longer with a long bias. We're telling them to be neutral. So now let's take a look at the first of as many of these country ETFs as we can get through. Okay, here we go. Let's flip to our first chart. So all these charts I'm going to show you here on these country ETFs are weekly charts. You should be looking at dailies also, but just for if you're going to invest in another country, I'm assuming it's not going to be a 2-week trade. It could be, but let's kind of look medium to longer term. So that's why we're going to look at weekly charts. So I look at Canada here. Top down in the early 2018, like many markets did, and have not been able to make new highs this year. So that's still in 2018 is still the high. So subsequent to the high, there's still some type of resistance. We'll say, where that line is. So we've essentially triple top. We're beneath both the 50-week and the 200-week moving averages. The 50-week moving average is here in purple. The 200 is in orange. So you look, we're beneath that now. But notice over the last several weeks, we still have not been able to break beneath the propulsion, the weekly propulsion level of 27.24. If this week closes up on the week versus last week, and then next Friday you close underneath that and gap lower the next Monday morning, then this looks like it's going down to 25.32. On the upside, you would have to close this Friday above 28.79, gap higher next Monday. If that happens, then this looks like it can challenge the all-time high at 30.36. So I'm kind of neutral here. It's mid-range, nothing much. Negative MACD. We're underneath the moving averages. We couldn't make new highs. Minor negative bias. Let's move to EWW, Mexico. Mexico, far different looking chart. Look how much weaker this is. So here, let me just flip back again. So here's Canada, right? It made its high in 2018. The all-time high is all the way back here, actually in 2014. And it's kind of been, steady in here. And when we go to EWW, look how much weaker this is. This keeps having lower highs. So a much weaker chart. And here's an example that if you had been long Canada and short Mexico over the last 6 months, you did quite well. And again, you took the direction out of which way the market went out of the equation and purely made a bet on which of those two countries would do better than the other. And that's the advantage of pairs trading, and that's the advantage of being able to look outside the US and use geopolitics and other things going on in the world to help make money outside of just trying to guess which way the US market is going to go, which is not the easiest thing these days either, just because of the way this particular president communicates and when he does, and etc. Things we've talked about before. So the Mexican chart is much weaker. It's on an 8 count here. It basically has a double bottom versus last year's low. Notice on the counts here, we're in a setup 8 and a sequential 11, which means in a couple weeks with further weakness, we could get both 9 and 13 coming in at the same time. So this may be getting closer to making a bottom just at the same time that we could potentially take out that Christmas low. You also may run a lot of stops underneath there, and then you've got to see if this starts to balance out at all, because if it does, then it's probably a buy for an intermediate term rally. Let's move to Europe, and I'm going to start with FEZ, FEZ. FEZ is the equivalent, it's an ETF that's the top 50 names in all of Europe. So let's call that like kind of the Dow Jones Industrials of Europe, the top 50 names in all the countries that make up Europe. So this is well off the December lows. Let's get rid of this line here because this one is not relevant. Nor is this one. These are carryovers from the previous chart. So same type thing here. Go back in time. 2014 actually made the all-time highs. 2018 essentially challenged them. So like many other global markets, this peaked in early 2018, sells off, gets a perfect 13.9 bottom into the Christmas low. Does a 13 on the top here and is pulled back. So this is also, I'd say it's more similar looking to, let's say, the U.S. in the sense that we peaked earlier in the summer. We've been down since. Hasn't gotten a proper break of 35.90. What is that? 98. The propulsion level. So let's see, down closed last week by a little bit, up close this week. So if this Friday, if next Friday, which would be the first Friday in September, closes beneath 35.98, and the next Monday morning we gap down, then you get a propulsion sell signal looking for 32.91. So percentage-wise, it's actually, could be a quick little nice trade there. Europe, and we'll see this as we look at other European indices, you're going to see that they have peaked out and did not make new all-time highs the way the US did. Let's move to Germany. EWG. So in 2018, this took out the 2014 highs, made new all-time highs, but didn't come close this year to getting up there. Now, I will tell you, all these ETFs we're going to look at that begin with EW, and then they have a different letter for which country it is, G being Germany in this case. These are dollar-based. So you have to take into consideration that this has US dollar exposure in it too. There are ETFs that have hedged currencies. They take the currency out of the equation. So then you have a pure play in that actual index in local currency terms, not in US dollar terms. So I figured I would mention that. If you look at, so this all-time high, looks like we've got, there's a downtrend in place. There's still lots of lows. That's the 2015 lows, 2016 lows. Just drew a line here at the Christmas low. Or close to it. I might have missed it by a little bit here, but we're getting down towards support. So this 23, low 23s level is going to be very important for this chart. You're not going to want to see it break underneath these 2016 lows. And as far as resistance, the cloud looks like it's resistance here, as are the 50 and the 200 week. You only minimally got through them on the last time up. So this is kind of a bearish looking market, especially with this high here in 18, having taken out the 2014 high. It wouldn't surprise me tremendously if we dip beneath here and kind of, not only the way you got new buying coming in that ultimately became the high, it wouldn't surprise me if Germany ends up making new lows before it bounces. Let's look at just the UK on its own, because you've got Brexit issues here that are certainly affecting people's willingness to invest in this area, and you can see how much weaker this is. So this is now near the Christmas lows. The good thing is we could get a bounce from the setup 9 count. A lot of times 9s give you bounces. You'll see the all-time high was well, not the all-time high. The 2018 high was on a setup 9 up. The all-time high was on a 9 up. This 9 up here and earlier this year was only a couple weeks away from the high of the year. So we are getting closer to some support as well as the Christmas low. You've got to watch how and what it does underneath the lows here, whether or not you get a much fuller decline to the downside. And just move this line there. So heavy looking chart, but certainly coming into longer term support into this zone here. So the next few weeks are kind of important here. MACD, obviously, we're picking up a little downside steam as momentum is picking up to the downside. And of course, you've got a new prime minister in the UK, and he still has to deal with all the Brexit issues. Let's look at EWI. Here's Italy. Now, here's a place that a lot of people just, you just don't think of investing in on any regular basis. And yet, if I look, and again, I've got to take these lines out that come from the prior chart. Oops. Notice here how accurately the sequential model has helped call. There's a 13 in here, just a few weeks before the bottom. There's a 13 on the all-time high in 2014. There's a 13 on the 2018 high. There's a 13 on the 2018 low. And this is why we use this model for In the Know Trader. Remember, I developed In the Know Trader, our newsletter for individual investor clients, using institutional models. And this is a model that very few people have access to, certainly very few individuals. It costs a fair amount of money, but institutions do trade off of this. And sure enough, you can see that several of these signals showing trend exhaustion have been very accurate. This is still holding on to the bottom of its cloud near term. Come out through the bottom, and you'll get another few weeks of downside action to test the Christmas low. Let's finish up with France. EWQ. And again here, 13 on the highs, 13 on the lows last Christmas. We only got to a 12. We just missed getting a 13 signal this year. Hanging out mid-range, and nothing of particular interest here to me. So I'm going to say I just don't see much here. Let's move to Asia. And this is not an ETF that starts with EW. My preferred is the iShares MSCI India. It's INDA. We've traded this very successfully in the Know Trader. We got long actually earlier this year, rode and got out nicely. You can see same type thing, 13 near the bottom, 9 on the top. We've just recently done a 9 and bounced. Mid-range, you're underneath moving averages. Not much to exploit here. Other than the potential looks like. Let's take this, and so we didn't quite get down to the trend line. We're still above it. And let's see if there's. It's a triangular pattern that you're getting closer to the middle. Looks like just based on a bunch of lines here on a further rally to to these lines being grouped together up to, let's say, so anywhere from 33.5 to 34.5 should be some resistance now, but you're in the middle of a triangle, not a heck of a lot. And that's going to happen in a lot of places simply because we're off the highs and we're still above Christmas lows most places. Here's Japan, EWJ. This is one of the first ETFs that came out to do, to be able to get exposure in other countries. So this has had long-term history as far as trading goes, and a lot of interest because it's the easiest way people have been able to get into Japanese exposure. Here's the downtrend off of the highs made in early 2018. This year's high fell short of it. You actually have pretty much a triple top going across here. So until it breaks out through both the downtrend line and the triple top, unless you want to buy weakness, there isn't much to do here as far as buying. Given the price at 53.5 right now, and the breakout at, let's say, above 56, that's only 2.5 times 2. That's only 5% higher. Before you get a cleaner breakout towards the upside, and that at least gives you room up to about 61 or so as far as projection on the upside. If we get a propulsion sell signal underneath 52, it would suggest that we would test and probably take out the Christmas low to get to 48 down to 46 as targets. Let's look at Hong Kong. So this has also multiple 13 signals near its highs in 2018. This year we got to a 12, just missing getting another 13 signal for upside exhaustion. Mid-range still above the Christmas lows. I don't see much here other than it's mildly heavy, but not super heavy. But there's definitely, just look at the MACD and what's gone on in the last month. There's huge decline there. Of course, there's some political unrest, and that's adding to the selling pressure. And again, this is the type of thing too that you can take advantage of when you see headlines. Let's look at FXI. This is one of the biggest China ETFs. This has also been around for quite some time. Basically, double top up there versus the 2015 high. In the next several weeks, how and which way if we break under 37.88 is where problems potentially really mount. On the upside here, no real clear resistance other than, let's say, where we draw a downtrend. And let me finish up with the Russia ETF. Some people like to play, again, whether it's politics or just natural, it's a natural resource type of economy, and therefore tends to do better when natural resources do better. And look, you may not want to invest in Russia, I get it, but it's the type of thing that it's pretty straight. It's a couple of years already where it's fairly flat, so not a heck of a lot to do. So anyway, this at least hopefully gives you a little exposure into investing in other countries and what it's like and how to do it. So open your eyes to looking at what opportunities exist in other countries. That's it for this week. I'm Rick Bensignor. Thanks for tuning in.